Let's now prepare the statement of financial position of Comfort pension scheme. So you write Comfort pension scheme. Income statement of financial position extract. Statement of financial position extract as at 31st October. As at 31st October, we have 2016 and 2017. Our figures are in millions. So, present value of plan obligation, carried down, I can see the figure is 100 and 125 respectively. Fair value of plan assets, carried down, the figures are 96 and 110 respectively. And therefore, our net pension obligation, net pension liability, stroke asset, because it is either way, should be 4 for 2016, which is a net pension liability, and 15 for 2017, which is also a net pension liability. And that's how you are supposed to present your statement of financial position extract. Now, I would like to refer you to another question, still on the same, on employees' benefits, from June 2012. From June 2012, question number 3. From June 2012, question number 3. Let's get there. The question reads, 𝘧𝘵𝐾 Limited operates a defined benefit pension plan. The following financial data relates to the scheme for the past 3 years ended 30th April 2012. You have been given the discount rate at the beginning, the expected rate of return, current service cost, benefits paid, contributions paid, present value of obligation, and fair value of obligation. The present value of obligation and the fair value of the plan assets were both 1,000 million as at 1st May 2009. The company reports all actuarial gains and losses arising in the year directly in the retained earnings. You are required to, Roman 1, determine the actuarial gains / losses for each of the years ended 30th April 2010, 2011, and 2012. Then the income statement expense for each years ended 30th April 2010, 2011, and 2012. Then the asset or liability to be reported in the statement of financial position as the 30th April 2010, 2011, and 2012. So let's have the solution. Let's have the solution. So let's start with determination of actuarial gain / loss on pension assets. Determination of actuarial gain / loss on pension assets. So we are going to start with plan assets. Plan assets. We have 2010, 2011, 2012. Our figures are in millions. We are going to start with the fair value of plan assets brought down. Fair value of assets brought down. I can see for both assets and liability, the figure was 1,000 million. Then you add expected return. You add expected return on plan assets. We know the rate is 12%. 12% of 1,000 is 120. Then I add contributions made. Contributions made. Contributions made in 2010 is 90. Then I less benefits paid. Benefits paid. For 2010, it was 150. And once I work out the expected value of assets, expected value of plan assets, let me work it out. It will be 1,000 plus 120 plus 90 minus 150. This gives me 1060. Then we'll get the actuarial gain stroke loss, and then the fair value of assets carried down. We know that the fair value of the plan assets carried down in 2010 was 1190. And therefore, there was an actuarial gain of the difference between these two values, 1060 and 1190, which is actually 130, which is a gain. So I open 2011 with 1190. I know that the expected return in 2011 was expected to be 11%. It was expected to be 11%. So 1190 times 11%, I get 130.9. Then contributions made in 2011, I can see it was 100. Benefits paid in 2011 was 180. Once I work it out to get the expected value of the asset, I add 1190 plus 130.9 plus 100 minus 180. I get 1240.9. And I know that the fair value of plan assets carried down in 2011 was 1372. Therefore, there was an actuarial gain again of the difference, which is 131.1. Again, it is a gain. I open 2012 with 1372. Expected rate of return in 2012 is 10%. This is 137.2. Contributions paid, I can see in 2012, it was 110, and the benefits paid were 190. Therefore, the expected value will be 1372 plus 137.2 plus 110 minus 190. I get 1429.2. And I know that the fair value of plan assets carried down in 2012 was 1188. And therefore, our resultant actuarial loss, because I can see it was a loss, was 241.2, which is a loss. Then, from there, we get to the gain or loss on plan obligation. Determination of gain stroke loss on plan obligation. Determination of gain stroke loss on plan obligation. So you write plan obligation We have 2010, 2011, and 2012. Our figures are in millions. We are going to start with the fair value of plan assets brought down. We know that for, present value of plan obligation. Present value of plan obligation brought down. We know that for both assets and obligation, they both had 1,000. Then you add interest on obligation. Interest on obligation in 2010 was 10%, which gives me 100. Then you also add current service cost. Current service cost for 2010 was 130. Then I less benefits paid, since we don't have past service cost. Benefits paid in 2010 were 150. And therefore, expected value of obligation will be 1,000 plus 100 plus 130 minus 150. It gives me 1080. Then actuarial gain stroke loss. Actuarial gain stroke loss. Then we get the present value of plan obligation carried down. I know the figure is supposed to be 1,100, and therefore we expected 1080, we got 1,100, the resultant figure is a loss of 20. Then from there, 1,100 becomes the balance brought down for 2011. Rate of interest in 2011 was 9%. 9% of 1,100 is 99. Current service cost for 2011 is 140. And the benefits paid in 2011 were 180. And therefore, our expected value of plan obligation in 2011, I add them together and I subtract 180. This gives me 1,159. And I know as at the end of 2011, there was the present value of plan obligation was 1,380. So again, there was a loss of the difference, which gives me 221, which is also a loss. I open 2012 with 1,380. I open 2012 with 1,380. The rate of interest in 2012 is 8%. So 1,380 times 8% gives me 110.4. Then the current service cost for 2012 was 150. And the benefits paid in 2012 were 190. And therefore, my expected value at the end of 2012 will be, I work it out, it gives me 1,450.4. Then from there, we know that the actual present value at the end of 2012, as per the question, was 1,408. And therefore, this time there was a gain of the difference, and the gain is for 42.4, which is a gain. So the net actuarial gain stroke loss, in 2010, there was a gain of 130, a loss of 20, which gives me a net gain of 110. Net gain of 110. In 2011, there was a loss of 221 and a gain of 131.1. So once I get the difference between those two figures, I get 89.9, which is a loss. In 2012, I had a gain of 42.4 and a loss of 241.2. So once I offset them, I get 188.8, which is a loss. 188.8, which is a loss. Therefore, I can now comfortably prepare the income statement extract. I can now comfortably prepare the income statement extract. So let's prepare the income statement extract. You write 𝘧𝘵𝐻 Limited income statement extract. Income statement extract for the year ended 30th April 2010, 2011, and 2012. So, income statement extract. We have 2010, 2011, and 2012. Our figures are in millions. We are going to start with the current service cost. Current service cost is 130, 140, and 150. Then we don't have past service cost, but we have interest expense. Interest expense is 199 and 110.4 from the plan obligation. Then we have expected return on assets. It was 120, 130.9, and 137.2. These ones will be subtracted, and then actuarial gain stroke loss. In 2010, we had a gain of 110, which should be subtracted. In 2011, 89.9, which is a loss to be added, and 2012, 188.8, which is a loss, should be added. So once I work it out, 130 plus 100 minus 120 minus 110. It comes to 0 in 2010. In 2011, 140 plus 99 minus 130.9 plus 89.9. I'm getting 198. And then in 2012, 150 plus 110.4 minus 137.2 plus 198.8, it gives me 322. And this is our net pension. This is our net pension cost. This is our net pension cost. From there, let's now prepare the statement of financial position extract. Let's now prepare the SFP extract. So you write 𝘧𝘵𝐻 Limited SFP extract. 𝘧𝘵𝐻 Limited SFP extract as at the 30th April, 2010, 2011, and 2012. Our figures are in millions. present value of plan obligation. The figures were 1100, 1380, and 1408 respectively. When it comes to the fair value of assets, of plan assets, carried down, the figures were reading 1190, 1372, and 1188. So, net pension liability, 1100 stroke asset, can be an asset, stroke asset. 1100 minus 1190, you get 90, which is a negative. 1380 minus 1372, you get 8, which is a positive. 1408 minus 1188, you get 220, which is a positive. And therefore, that's how you are supposed to go through that question. And basically, that's all about accounting for employees' benefits. We have used the two past paper questions to exhaustively demonstrate the concept of employees' benefits. So till next time when you'll be doing another aspect of assets and liabilities, have a nice time.